Good morning, students. Welcome back to the session on Ind AS. Today we are going to continue with the financial instruments. In the financial instruments, we started with our discussion on Ind AS 32. We were majorly covering about financial assets and financial liabilities in terms of their classification. We also understood their measurement, and we didn't get into their reclassification. Before that, we moved on to this understanding of difference between financial liability and equity. And as I told you, this is going to be the focus, and this is something which has been majorly covered under Ind AS 32. So that's why after this classification and measurement, we are now covering this aspect. So today we plan to cover this aspect in more detail. In the last session, we touched upon certain points which one has to remember while differentiating financial liability from equity. Yeah, remember? So one of the points which we discussed last time around in terms of differentiating between financial liability and equity was about our understanding of the contract. We all understand that financial instruments cannot exist if there is no contract. But at the same time, it's very important for us to remember that we need to go by the terms of the contract in case of financial instrument and in terms of differentiating financial liability from equity. That means if we have any different understanding, like in terms of distributions, the expectations, etc., in terms of repayment of the amounts which may be involved in respect of those financial instruments and which may not be mandatory on the part of the issuer, then we need to only consider those payments or those repayments which the issuer cannot avoid, which he will not have any option but to pay. Because only in that case, when he will have no option but to pay, instrument will be classified as financial liability from the perspective of issuer. And now, in this entire discussion, you'll have to remember that the perspective that we have been discussing, that we have been considering, is all from the issuer side. It has nothing to do with the holder. Yeah, remember? So the same understanding we will continue, and I'm hoping that you would have revised all the points related to financial liability and equity, which I gave you as a homework, sort of homework for the purposes of our discussion today. Yeah, and I also gave you some illustrations for homework. I think it was one or two. I'm hoping that you would have covered that illustration as well. Yeah, I would request all of you to please confirm whether you have completed the homework or not. Yeah, and then we can just now start with our discussion. Okay, so now I'll start with one more illustration. Yes, so this illustration which is there in front of you. Yeah, and I would request all of you to solve this and let me know what's the answer. All right, yeah. Entity A issues undated preference shares with 6% dividend. In the last session, I remember there was some question regarding redeemable or irredeemable instruments. So what I would request all of you is to please ignore the legal aspects in relation to instruments that we have been discussing. Because our focus in this discussion is only in respect of accounting. So if you believe we have been discussing an instrument which is legally not possible, okay, because there could be certain challenges, certain regulatory approvals, etc. may be required. So that part you should ignore, because what is our focus? Our focus is to understand the accounting requirement in relation to any such instrument and to understand how should that be assessed. Okay, Yeah, because accounting is different from the legal provisions. So the legal provisions we should ignore completely. So please don't get deviated. Yeah, in terms of your understanding of that instrument, focus on the accounting requirement. Please. So wherever there will be any legal provision, we'll take care of that. Okay. Entity A issues undated preference shares with 6% dividend. This entity is listed. It has a credit rating of AA and operates in a stable economy. Now in this case, who is the issuer? In this case, entity A is the issuer. Correct? Very clearly it's known to us. Market rate of interest is 5.5%. And the undated preference shares have been issued at 6% dividend. Undated means there is no date of repayment. Okay, there is no date of repayment. Shareholders may not redeem the preference shares. However, entity A may repay them after the 5th year. So entity A, that means issuer may repay after the 5th year. After the 5th year, if these are not repaid by the issuer, that means entity A, annual dividend on the preference shares will be stepped up to 20% cumulative. So currently the annual dividend is 6%. If the repayment is not done after the 5th year, what will happen? This annual dividend will increase significantly to 20%, and that too cumulative. Cumulative means something which will keep accumulating even if this is not paid. Entity A has full discretion on dividend distributions. However, it may not pay dividend on its ordinary shares before paying the dividend on preference shares. So that means before making the payment for equity shares, it's mandatory for the payment to be made on preference shares. In this case, these preference shares are required to be classified either as equity or liability on which your inputs are required. So I would request all of you to let me know, what do you think this instrument will become? Equity or a liability? All right. Yeah. So I'm just waiting for your inputs. In the meantime, I've received a couple of queries from Webby and Costa. So I think their query is around question number 22 of the homework, which is, I think, in respect of the interest calculation. Sure. So what we can do is maybe we can take it up either towards the end of today's session or maybe in the next session. So let's see how the things progress. So either towards the end of today's session, we can take it up as the time permits. Otherwise, in the next session, we will take it up. Okay. Yeah. Yes, quickly. I'm waiting for your responses now. While answering this, please remember the points that we discussed last time around. And on the basis of that, you need to be very, very careful. Okay. Yes, you can start answering now. It's not very complicated, but definitely you will have to go by the discussion that we had in the last session. And you should also give reasons briefly why you would call this to be an equity or a liability. And as I told you, the focus of our discussion today will be all about equity and liability. Yes. Yes, quickly. What's your response? What will you call this instrument as? Equity or liability? Quickly, huh? Now I think you are taking too much time. Yes, tell me, what will you call this instrument as? Equity or liability? Just go by the understanding of equity or a liability, and then you need to respond accordingly. Yes, I'm waiting for a response now, but you need to be quick. What will you call this instrument as? Equity or a liability? Yes. What will you call this instrument as? Equity or a liability? Should we go to the solution then? I think this is relatively simpler. Okay, so let's get to the solution. Now in this case, there are again two things which we need to check. As I told you, for any instrument, we need to check two things: principal and interest. And we need to check whether the issuer will be mandatorily required to pay cash on both these components or for both these components or not. So now, because these are undated preferentials, yeah, so that means principal payment is not required to be done. Principal payment is not required to be done. Correct? Let's understand about equity. Now I've received your responses. Chavi is saying, sir, it has to be equity. Kostav is saying equity. Vaibhavi is saying equity. Okay, very good. Now let's understand about interest. What is interest? It's nothing but dividend in this instrument. In terms of dividend, it's required to be paid at 6%. And there is an obligation on the part of entity A for paying dividend at the rate 20%. Correct? For paying dividend at the rate 20%, which is very significant. But whether it is 6% or 20%, which may just keep increasing at every point of time, whether the dividend will be paid or not paid will always be at the option of the issuer. So that means issuer has an obligation of not paying this dividend. Even though prepayment of this dividend or the payment of this dividend on an annual basis will financially benefit entity A, but still entity A has an option as per the contract to avoid its payment. So that's why, what will it become? That's why, what will it become? That's why it will become again sort of equity. Yeah, Vaibhavi has the same answer. Now, because both these components can be avoided to be paid, that's why, what will you call it as? Equity. Okay. Yeah, clear on this? Very good. And it's good to see that all of you have answered equity in relation to this illustration. Now, moving further. Again, continuing on the same point, it's about debt versus equity. There is another thing which is called as contingent settlement provision. What is this contingent settlement provision? Sometimes in the contract, there could be certain terms which may not be within the control of the issuer and which at times may also not be there in the control of the holder. And when we say there are certain terms, provisions which exist in the contract, and which are beyond the control of either the issuer or the holder or both, such terms provisions may require issuer to pay cash. Okay. So what would it mean? That contract has a provision which again issuer is not sure whether that provision will be triggered or not. That's why we are calling it as contingent. Means because of that provision, issuer may be required to pay cash. But even though issuer is required or may be required to pay cash, it's not necessary that such provision will get triggered, because that is contingent. That is contingent on certain event which will occur in future. Yeah. Now, in such a case, what do we do? In such a case, if the issuer will think, what will he say? He will say that I don't know whether this future event will occur or not. That's uncertain. But in case this gets triggered, then I may be required to pay cash. And what would it mean? Now, because issuer is in a situation wherein he cannot avoid payment of cash in every situation. Okay. Why are we saying that? Because there could be a trigger which may arise in future, which is not within the control of issuer and which may require issuer to pay cash. That's why such an instrument, because of existence of such type of provisions, will be called as financial liability. And such provisions are called as contingent settlement provisions. Okay, yeah. We need to now understand some of the examples. Some of the examples of such contingent provisions which are there in front of you. Let's try to understand. So on the left hand side on the screen, you will see various events are given. We need to check whether the event is within the control of the issuer or not. Issuer makes a distribution on preference shares. Can we say this event is within the control of the issuer? Yes. So can it become contingent settlement provision? No. Event of default under any of the issuer's debt facilities. Can this be there in the control of the issuer? No. Disposal of all or substantially all of issuer's business undertaking or assets. Can this be within the control of the issuer? Of course, yes. Issuer can control it. Change in credit rating of the issuer. Now, who decides the credit rating? It's a credit rating agency, which has to be independent of the issuer. So can we say that this is within the control of the issuer? No. Upon suspension of listing of shares of issuer from trading on the stock exchange for more than a certain number of days, can this be within the control of the issuer? Again, no. A change in accounting, taxation, regulatory regime, which is expected to adversely impact the issuer, which may have an adverse impact on the issuer. Can this be within the control of the issuer? Again, no. Issue of an IPO. What is an IPO? Initial public offering. So issue of an IPO. So let's suppose there is a company which wants to get listed. So what will it do? It will come up with an IPO. Yeah, this is called as issue of an IPO. Can this be within the control of the issuer? Of course, yes. But whether that IPO will become successful or not. Can that be within the control of the company? No. So success of an IPO will not be there in the control of the company. But yes, coming up with an IPO is definitely within the control of the company or the issuer. Okay, yeah. Clear on the meaning of contingent settlement provisions? Now, these are only examples. Similar to these, there could be various other events which may not be within the control of the issuer, and because of which issuer may be required to pay cash. That is something that we need to understand at every point of time. Okay, so let's look at one example which again you need to answer, and on the basis of this example we will understand how this contingent settlement provision can impact our assessment of liability versus equity. All right. An undated cumulative convertible bond for which interest payments are at the discretion of the entity contains a clause that states that the instrument, including all unpaid cumulative interest, will become mandatory payable if there is not an IPO by the end of 3 years from the instrument's issuance date. How would this instrument be classified as under Ind AS 32? All of you, can you please answer this? Yes, quickly. Can you please answer this? Yes, quickly. Can you please answer this? What will you call it as? This instrument will become equity or a liability? I'm hoping you have understood the question. Yeah? Yes, quickly. I need your answer quickly, please. Will you call this instrument as a debt or an equity? Yes. Will you call this instrument as a debt or an equity? Quickly. Waiting for a response. Okay, great. So Rohit has answered this. Rohit is saying it should be equity, and the reason is missing. I would request all of you to please give your reasons also briefly. That helps to understand. Okay, Chella is saying, could you please explain how to determine credit rating by credit rating agencies? See, that is not an area of accounting. How to determine credit rating is based on certain norms which they follow, which is dependent on the performance of an entity. So we are not required to get into the determination of a rating. We just need to understand that if the rating of the company is A, triple A, double A, B plus, how is that decided? That is decided by a third agency, which is independent of the company and which is not within the control of the company. Okay, great. Chavi is saying that it has to be equity because it's within the control of the entity. Guru Raja is saying that it has to be equity because IPO is under the control of an entity. Pujita is saying no LPO, no IPO present, financial liability, else it would be an equity. Thus, it's a contingent settlement provision. So I think Pujita has answered this in a very different manner. Idea was to understand about whether it's an equity or a language. So now in this question, I think some of you might have understood the requirement of IPO as an issuance of IPO. Whenever we talk about an IPO, IPO will always mean, until unless it's specified, that IPO becomes successful. Okay, that means the company gets listed, IPO becomes successful. Therefore, in this question, if we look at the understanding, what's the understanding in this question? In this question, the instrument is convertible bond. Yeah. So in this question, instrument is convertible bond. So if we look at the principal, it's not required to be paid. On which interest payments again are at the discretion of the entity. So principal is not required to be paid and interest is also not required to be paid. However, in case there's no IPO, then both principal as well as interest become payable, and that too cumulative. That means whatever has not been paid since beginning will become payable. And can this payment be avoided by the issuer? No, because issuer is not sure about this event. This event is not within the control of the issuer. So that's why you can see two contradictory terms existing in the contract. The contract is actually an equity instrument. If you go by the terms of the contract, ignoring this contingent settlement provision, then you would have called this instrument to be equity. You would have immediately and very easily called this instrument to be equity. But this contingent settlement provision is also a part of the contract. It's not outside the contract. And this changes the whole scenario. This requires this instrument to make mandatory payments, which may not be done immediately, which may be done after some period. But it doesn't matter to us whether the payment is done immediately, regularly, or it's a one-time payment. Important thing is that is the issuer in a position to avoid payment, which is not there. If you look at the contingent settlement provision, it's not there. So that's why, because of this contingent settlement provision, what does this instrument become? Financial liability. So that's why, what do we say in this case? It has to be a financial liability and not an equity instrument. Okay, clear on this? Yeah. All right. Yeah. So what we can now do is, we can now move on to some more illustrations to practice all of these sort of questions. Let me just take you to some more illustrations now. Okay, I think these are very, very simple illustrations, but still we can get on to these illustrations. Yes, so you can go on to illustration number 1 on page 12.29. Sorry, 12.28. Illustration number 1 on page 12.28. Yeah. Yes, let's get on to this one quickly. I also received a couple of responses. I think one was Challa, which I discussed. Ambika said in the last example, it should be classified as contingent settlement as liability. Very good. Okay, now moving to this illustration number 1. Redeemable preference shares with mandatory dividend. A Limited is an issuer. It's specified in the question. It issues preference shares. It issues preference shares to B Limited. Those preference shares are redeemable at the end of 10 years from the date of the issue and entitle the holder to a cumulative dividend of 15%. Okay. The rate of dividend is commensurate with the credit risk profile of the issuer. Examine the nature of this financial instrument. Means whether this instrument will become equity or a financial liability. Yes, all of you. I think very simple for you to answer. This is very simple for you to answer. Yeah. In this instrument, what do we see? It's redeemable. So principal is payable and the interest, that means the dividend, is also payable. Yeah. So what will this instrument become? Financial liability. Yeah. Easy to understand? Okay. Now moving on to illustration number 2 here. So you can see that these are all illustrations from your study material. And if you find these examples, illustrations to be easy, you can just understand your situation right now, that you are now prepared for the examination or not, because these are all coming from the study material directly. Okay, so that's the perspective. That's why I moved on to the study material. Because some of you may be thinking, sir, why we are practicing some more of these illustrations? These are simple. These may be simple, but important thing for you to understand is that you are finding these things simple or not. Because this is what your study material requires you to prepare. Next illustration number 2. X company limited is an issuer. It's specified. Can you see in the question it's already given to you? It issues debentures to Y. Those debentures are redeemable at the end of 10 years from the date of the issue. Interest of 15% per annum is payable at the discretion of the issuer. The rate of interest is commensurate with the credit risk profile of the issuer. Examine the nature of the financial instrument. Yeah. Now in this case, if you look at the question, principal is mandatorily required to be paid, but interest is not mandatorily required to be paid. Okay. When you have such type of situation wherein some part of the instrument will require mandatory payment, which issuer cannot avoid, and some part of the payment which issuer can avoid to repay, that becomes compound financial instrument. Compound financial instrument, on which we'll have a detailed discussion slightly later. As of now, I'm not getting into that discussion. For the time being, you just understand that this instrument will have both the features of equity as well as liability. Okay, and how do you classify them? This will have to be broken into 2 parts, the way we have done. But in terms of its accounting, we'll have a discussion on this today, but slightly later. Okay. Now, moving further, let me just take you further now. All right, so now we are moving further. If you remember, there was some part of definition of financial liability which we had skipped. You remember, all of you? The definition of financial liability was not fully covered by us. We covered obligation to pay cash, existence of a contract, unfavorable condition. So this was the part that we had covered. Yeah. If you go back to your notes, you will find that some part of the definition, or maybe the definition which included some more aspects because of which an instrument can become financial liability, was ignored by us. So now we are getting on to that part of definition once again. And you may be thinking, sir, are we going back to the definitions? Because these are all basics. When will we get on to the main thing? So in terms of financial instruments, as I told you, that definitions comprise of majority part of the financial instruments. Because all of the financial instruments are all about understanding of financial asset, liability, and equity. And that is what we have been discussing. And for the purposes of our discussion in relation to difference between debt and equity, again, we'll have to go back to that part of the definition. Okay, so now in a way that definition is also getting covered. Now, what does this part requires? An entity may have issued equity instruments, or an entity may have issued any instrument. Say, for example, an entity has issued convertible debentures. Okay. These convertible debentures will be converted into equity, let's say after 5 years. Okay. Now, what will you call this instrument as? Now, I will need your quick responses, please. Now, for the purposes of this part of the definition and this particular topic, I'll need your quick responses. Yes, all of you. So I'm talking about convertible debentures, and which will be converted into equity after 5 years. Yes. Now, in respect of these debentures, which will be converted into equity, and let's suppose interest is not payable. Again, you may think that, sir, how is it possible that the debentures are issued and the interest is not payable? For the purposes of our discussion only, let's assume this is possible legally. Okay. Now, in this case, what do you think will be the nature of this instrument? Equity or liability? Yes, quickly. I think this is very, very simple. So something which is simple, you should not take time on that. You should answer that quickly. Financial liability or equity? Yes, quickly. It should be a financial liability or an equity. For this type of instrument, what do you call it? Financial liability or equity? I'm discussing a very, very important point with you now. Costa is saying that it should be equity. Let's understand why. In this case, if you look at the principal, it's not required to be paid by the issuer. Why? Because after 5 years, it will convert into equity shares. And if you look at the interest, there's again no mandate on the part of the issuer to pay cash. That's why this part will again become equity. Same is the response from Guru Raj. Now, let's understand how will this conversion take place. Because so far we have been discussing only the broad things, that an instrument will become equity at a later point of time. But now it's very important for you to understand how will that conversion actually take place. So that means now we need to understand what is going to happen at the end of fifth year. And we are not talking about going to fifth year. No, we are still on day zero. Today, standing here on day zero, we need to understand, because this part will also be mentioned in the contract itself. The contract will always specify how will the conversion happen, isn't it? All of these clauses will definitely be mentioned in the contract. Now, let's suppose when this contract is getting drafted or this contract is getting finalized, there are two parties, A Limited and B Limited. A Limited is the issuer. So that means B Limited is the holder. So currently A Limited has issued convertible debentures. A Limited has issued convertible debentures. So what has happened? A Limited has received cash. Cash has come to A Limited, which should be repaid by A Limited. But there's an understanding between both of them that instead of paying cash or instead of repaying the amount by A Limited to B Limited, what will A Limited do? Instead of paying cash, A Limited will issue equity shares. So that means sometime over here, equity shares will be issued. And who will issue equity shares? A Limited. And when A Limited will issue equity shares, what will happen? Loan will get debited and the equity will get credited. Correct? Because if you look at the current accounting entry which A Limited would have passed, what would be the accounting entry? Bank debit to convertible debenture. So this should have been the accounting entry in the books of A Limited. Yeah? And I'm not getting into this instrument, whether this is debt or equity. I'm just saying it's in the nature of debt. Legally, I'm not looking at it as per Ind AS because that aspect is not yet covered by us. So legally, this instrument is a debt. But whether it's debt or not, we need to understand as per Ind AS. We'll not go by the legal form. Legally, it may be debt or equity, that doesn't impact us. Now, after the end of fifth year, A Limited, instead of making payment or repayment, has agreed with B Limited that A Limited will issue equity shares. Now B Limited is asking that please tell me what will be the number of equity shares that you will issue and what is the amount at which we will settle this. Let's suppose it's 100 lakhs which B Limited has paid to A today. So will the settlement take place exactly equivalent to this amount, or will there be any variation? And let's understand why there could be a variation. Let's suppose A Limited says that I will issue you 1 lakh equity shares. I will issue you 1 lakh equity shares. Correct? Now 1 lakh equity shares will be issued, but at what price? That is not fixed. So A Limited is saying, don't worry B Limited. Whatever will be the market price at the end of fifth year, at that market price, I will issue equity shares to you. B Limited is fine with this. But in that case, can we ascertain the amount today as to the amount of this settlement which will happen after the end of fifth year? No, because that will be determined on the basis of market price at the end of the fifth year. But in case A Limited says that B Limited, don't worry, I will issue you equity shares 1 lakh and the settlement will be for 100 lakhs. And the settlement will be for 100 lakhs. So that means, in a way, the price per share is also agreed. And what's the price per share? 100 rupees per share. Yeah. Let's not get into the commercial sense of it. Because again, you may think, sir, they have received 100 lakhs today and they are also paying 100 lakhs after the end of the fifth year. For the purposes of our discussion only, I am saying 100 lakhs will be the settlement amount. My idea of understanding over here is slightly different. In the instance or in the case when the two parties have agreed on the number of shares on day 0 itself, as well as the amount of settlement, when these two are fixed on the day 0, on day 0, means at the time of entering into a contract, when both these elements are fixed, then such an instrument will be called as equity instrument, provided it meets the criteria of equity. Now in this case, we discussed that this instrument meets the criteria of an equity. You remember? We discussed why? Because principal was not repayable and because the principal was not repayable and interest was also not repayable. There was no obligation on the part of A Limited to pay both of them. That's why when we started on this example, yeah, all of you mentioned that, sir, it has to be equity. Some of you may have a different answer, but I'm hoping that you would have understood that this has to be an equity because both the elements are not required to be paid. Correct? Now, with this understanding plus the understanding in relation to settlement, so there are two components that we need to now understand. And it's similar to what we have done in case of contingent settlement provision. When we were discussing about contingent settlement provision, we were discussing first of all whether the principal and interest are payable or not, and how will they change in terms of their payment, or how will the understanding in terms of their payment will change on the basis of contingent settlement provision. And therein we discussed that we will disregard our understanding of the contract if that is different from the understanding about the contract that we obtain by looking at contingent settlement provision. So the same thing we are now required to do here. We will start with this, and this aspect, this part of the contract calls this instrument to be equity. After this assessment is done, we need to do one more test. So you can say two tests are now required to be performed by you always. And you may think, why, sir? Is this a new addition? Yes. So this is another aspect that you'll have to consider always, something which we didn't discuss earlier. So now I'm adding further for the purposes of classifying any instrument as equity or liability. And what is that assessment? Assessment number 1 is through this part, wherein we will check principal and interest both. Now, as per test 1, this becomes equity. Now, what's the test 2? Test 2 says for the number of shares and for the amount of settlement, do we see any variability or are both of them fixed? The moment we say both of them are fixed, today itself means on day 0 itself. Yeah. In such a case, that instrument will be called as equity instrument. So if we say number of shares are fixed and the amount at which they will be converted is also fixed, that means both of them have to be fixed and fixed today itself. Then such an instrument will become equity. That means if this instrument as per test 1, so this was my test 1. If test 1 calls an instrument to be equity, then I will perform this test number 2. However, if the first test calls this instrument to be financial liability, then I don't need to get into this test number 2. This test number 2 will only be required to be done when test number 1 will call any instrument as equity. So you can add it to your notes, please. Okay, yeah, it's very, very important. And if you look at the accounting standard, it will not mention these terms, test 1 or test 2, or when the test 2 is required to be performed. It is only for the purposes of our understanding. Okay, yeah. Now, in case our understanding is not fixed, let's suppose amount is not fixed, like we discussed that these parties have agreed on day 0 that 1 lakh shares will be issued, but at an amount to be decided later on, or at market rate to be checked at the end of 5th year. In that case, can we say both these things are fixed? No. In such a case, what will happen? Even though test 1 will call this instrument to be an equity, still, because there's a variability in terms of settlement, because of that variability, this instrument, instead of equity, will become financial liability. And you may be thinking, oh sir, how can this happen? This seems to be completely different from what we discussed earlier. You are changing the concepts altogether now. Because at every point of time, we were discussing that no repayment is required to be done, either for the principal or for the interest, which is there in this contract. Neither the principal nor the interest are required to be paid. Yeah, and which will not change even at the end of 5th year. Principal will not be required to be paid. Interest will not be required to be paid, and those will be required to be paid at the time of settlement. Still, you are calling this to be a financial liability. Yes. Why do we do that? Because the standard says if there is any variability in terms of settlement of this instrument, which we entered into with a party on day 0, during any time of the contract or at the end of this contract, then this instrument is not in the nature of an equity instrument. Why? Because something has been paid in a way by issuer to the holder. Okay, clear on this? Yeah. Now this variability may arise because of various reasons. I'll get to that table. Through that table, we will understand how can this variability arise. And you should also note down one technical term, which is again based on what we have discussed. Let's note down that technical term for the purposes of your notes. When the number of shares and the amount both are fixed, then such a concept or such a test is called as fixed for fixed. Fixed for fixed. Fixed for fixed. Okay. So now what I can say is that whenever it will be fixed for fixed, means both these things are fixed, and don't get into the language around it. So fixed for fixed, what is this language? Yeah, so this is how this has been called. Fixed for fixed. When both of them are fixed, then if the test number 1 will call an instrument to be equity, then such an instrument will continue to remain equity. Okay, but if any of these components or if any of these things are not fixed, then we'll say fixed for fixed principle is not there, and such an instrument will become liability. Okay, now I'm taking you to a table which you can use for the purposes of your notes later on. And as I told you, you can just make your own notes. This presentation will also be made available to you, and you will be thinking, sir, when will we receive the presentation? See, purposefully, I have not shared this with you as of now, because otherwise what really happens is your focus gets onto the presentation only. And I want you to focus more on some of the principles that we have been discussing instead of just getting into this presentation later on. And this will be more of a revision for your purposes later on. So you will get this, but for the time being, you just prepare your short notes. Some of these notes are very important for you. Okay. Now in this table, if you'll see, whenever there is any variability, scenario number 1, 2, 3, and 4, means there could be a variability either because of number of shares or because of amount, or it could be because of both. Then such an instrument becomes financial liability. Variability may also arise because of foreign currency element, on which we will have a separate discussion. On this aspect, there has also been a carve out. Carve out means difference from IFRS. We will also discuss that carve out. But in this table, what do you see? That whenever there is any variability, such a variability will make such instrument to be a financial liability instead of keeping that as equity. But if you look at scenario number 1, in that scenario, both the elements are fixed. Amount is fixed and the number of equity shares are also fixed. That's why we will say that fixed for fixed criteria is met. And that's why in this situation, only financial instrument will be called as equity and not a financial liability. But please note down that when the test number 1 will call any instrument to be a financial liability, therein you will not apply fixed for fixed, because you will say that, sir, we have now understood that for any instrument we should check whether fixed for fixed is there or not, because if that is fixed for fixed, then it will become equity, otherwise financial liability. Very good, I can agree with your point, but be cautious. This has to be done only for those instruments which are called as equity after passing test number 1. That means if an instrument has been called as a financial liability after going through test number 1, you should not apply this fixed for fixed principle on that. because fixed for fixed principal is meant only for equity. So you should not get onto financial liability for that. Okay, clear on this? Now, if you have any questions around it, please let me know. We will also get on to some examples to discuss this in more detail, because with the help of examples only we can get more clarity around it. In the meantime, I have got this query from Challa. Challa is saying, sir, could you please explain the holder point of view? See, the holder point of view, as I told you, will have to be determined on the basis of classification buckets that we discussed. What were the classification buckets? 3. Amortized cost, fair value through OCI, fair value through P&L. Now, in this contract, whatever is happening, two parties are doing their assessments differently. Because the way issuer will do the assessment is different from the way holder will do the assessment. Because issuer will divide, or you can say issuer will check whether the instrument will become equity or liability, or it may be both. Like I just touched upon that point, that an instrument may become compound financial instrument, wherein it may have to be divided into two parts. But such a breakup of that instrument into two parts will not be done by the holder. Okay, and we will get into more details of such classification, and we will also look at the holder point of view for those classifications when we will move on to compound financial instruments, because therein you will get more confused. Definitely, I can understand you will get more confused. So that's why therein I will also ask you that from holder point of view, what will it become? As of now, because Chella wants to understand this, so my question is to all of you. Yeah, in fact, you need to help Chella to understand this point. Now, for this instrument, okay, and let's suppose this instrument has number of shares as fixed and amount is also fixed. Correct? Yeah. So it has passed test number 1 for equity, test number 2 also for equity. From the holder's point of view, what will you call this instrument as? Quickly, I am waiting for a response. Including Chella, you also need to just think and tell me what will this instrument become. Quickly, I am waiting for a response. What will this instrument become from the holder's point of view? So I'm just digressing from our discussion, because this query has come and I find this query to be good for the purposes of your discussion. Yes, quickly. Can you tell me from the holder's point of view, what will this instrument become, and also give your reasons briefly? What will this instrument become? Quickly, huh? You should not take time, because such type of questions in the exam should be a time saver for you. Okay, very good. Excellent response has been received from Costa. He is saying financial asset. I think all of us know about it, Costa. You need to tell us that what type of financial asset it will become and why. It's fine to know that it's financial asset. Under what category you will take it? How will you take it? And what will be the reason? Tell me. There's some problem. Let me just quickly check. It is fine now. Okay. So whenever there's any problem, please let us know. Okay, fine. Yeah. So I understand it's all fine, huh? Costa, please confirm. All of you, please confirm. So there was some connectivity problem in the meantime, but I think it's all fine. Correct? It's all fine now. Okay, so I was discussing about classification from holder's point of view. Something which is an equity for another will become financial asset. So that means for holder, it's a financial asset. Now comes the point that what category it will fall into. The moment we say it's an equity for another, so can we say that SPPI will be met? No. And if the SPPI will not be met, so can it go to amortized cost? Can it go to fair value through OCI? Not possible. So where will it go? It will go to fair value through P&L. So that means holder will classify this as financial asset bucketed under fair value through P&L category and will measure this at fair value always. Clear? All of you? Yeah? Similarly, you will be required to do assessment for all the type of instruments for both the parties. Yeah? And I think Good Raja also had the same answer. Okay? Clear on this? Any questions from your side on this? Please let me know. Any questions? No? Okay, so then we can move on to some questions now. So what you should do is, let's get on to illustration number 7 on page number 12.13. Start solving this question, please. Illustration number 7, page 12.13. Yeah. Target Limited took a borrowing from Z Limited for rupees 10 lakhs. So it's a loan. Z Limited enters into an arrangement with Target Limited for settlement of a loan. So T Limited took a loan from Z Limited. Okay. Z Limited enters into an arrangement with Target Limited for settlement of this loan against issue of certain number of equity shares of Target Limited, whose value equals 10 lakhs. So that means T Limited will not repay this amount in cash. Instead, T Limited will issue equity shares. So the settlement will be through equity shares. So settlement in entities own equity instruments. For the purposes of your revision, you can please note down. And this will also be your homework. Definition of financial liability. Definition of equity. I'm calling this because some part of this definition was not discussed. So now after the session, you should revise this definition. You will understand all of these points. Okay. For this purpose, fair value per share to determine the total number of equity shares to be issued, means how many equity shares will be issued, shall be determined based on the market price of the shares of T Limited at a future date upon settlement of the contract. Means when T Limited will issue equity shares to Z Limited, its value is fixed. So equity shares will be issued equivalent to 10 lakhs. Okay, equity shares will be issued equivalent to 10 lakhs. But the number of equity shares have not been decided today. It's been decided the way the number will be computed. Okay, so number of equity shares are required to be computed, and that can happen at the end of this term. Means on settlement date, this number will have to be computed, not on the date of agreement. All right. Now in this case, you are required to check whether this instrument will become equity or financial liability from the perspective of issuer. Okay. Now in this case, please listen to my questions carefully. First, you need to tell me who is the issuer. So my first question. So you can say question number A, who is the issuer? Number 2, my second question. As per test 1, what will it become? Equity or financial liability? As per test number 2, what will it become? Equity or financial liability? And you can also tell me whether both the tests will be required to be performed or not. Yeah. So test number 1, whether it's required to be performed. If yes, then what's the outcome? Test number 2, whether it's required to be performed. If yes, what's the outcome? Yeah. So that's how I want you to answer these 3 things. Okay. So 3 parts is what your answer will be broken into. Yes, I'm waiting for a response now. Okay, Chella has shared his understanding. He says that simple, what I understood was if an instrument is financial liability, in issuer's view, it is AMC, amortized cost, or fair value through OCI from holder's point of view. If it's an equity from issuer's point of view, same should be fair value through P&L from the holder's point of view in majority of the cases. Yes. And you should say that in both the cases, you will have to do independent evaluation. Though your understanding will generally apply and give you the outcome, what you have mentioned. But still, please don't go by this as a norm. You need to test it for both the parties separately always. Okay. Okay, great. Chavi has answered this very quickly. Very good. So Chavi is saying, sir, for A, my response is T Limited. Means T Limited is the issuer here. Then Chavi is saying for B, financial liability. And test 1 fails. For B, it's a financial liability. So Chavi is saying it's a financial liability. Test 1 fails. No principal, no interest. So when you say test 1 fails, no principal, no interest, this last part I didn't understand, but I could understand your point that as per test, you are calling this to be a financial liability as per test 1 only. Okay, no problem. Then Ambika is saying issuer is target. Ambika has the same answer. And Ambika is saying test 1 is required to be performed because settlement is through equity And as per test 1, it's equity. Okay. So Ambika is saying it's equity. So it's different from what Chavi has mentioned. And as per test, and then test 2 is required to be performed. So what is the outcome as per test 2? That is missing. Ambika, you need to respond for test 2 also. Kaustav is saying yes, T limited is the issuer. So great. So that means you are clear on the issuer and holder. B, test 1 has to be performed, whose outcome is equity. So he is also going with equity. Test 2 will also be performed, but it will fail as it's not fixed for fixed. So that's why it will become financial liability. Okay, great. Then Ambika is saying, sir, I answered for illustration number 7. Yes, that's true. So we are also on illustration number 7. That's true. But I'm talking about this test number 2. Yes, test number 2 was the outcome of test number 2. You need to respond. Now, Preeti is saying issuer is T limited. Very good. And test 1 is equity. Test 2, she's saying it will become financial liability. Same response which Kaustav has shared is what Preeti agrees with. Rohit is also talking about the same answer. Okay, great. Yeah. Okay, very good. So let's get on to this answer now. Though you may be answering. Okay, so Ambika is also going with financial liability in this case. Very good. Now in this case, clearly T limited is the issuer. It's now clear to all of us. And if you look at test number 1, we need to check whether the principal will be repaid. No, because it will be converted into equity. On loan, again, we don't know. So we assume it will also not be repaid. So it becomes equity because of that. It becomes equity because of that. Now, if you look at test number 2, it requires equity to stay as equity only when fixed for fixed criteria will be there. Fixed for fixed criteria will be met. But in this case, the number of equity shares are not fixed today. There is a variability. So because of this variability, what will happen? This will become financial liability. So even though test 1 calls this to be an equity, its outcome will change. Finally, it will be concluded to be a financial liability. Clear? All of you? Yeah? And I'm hoping with this, it's easy for you to understand. And now I would request all of you to please go through the solution which is given in the study material. You can just take a couple of minutes to read the solution of the study material. Yes, quickly. Can you go read the solution of the study material? And please confirm if you have done that. Chella and Guru Raja have also confirmed their responses are matching with what all of you have mentioned. So that means all of you are going with the same answer. Yes, once you have read the solution of the study material, please let me know. Done? Read that part? Yes, read that part? Yeah? Read the solution? Okay, great. So now, when you would have read the solution of the study material, it's not divided into 3 parts like this. Yeah? So, I would therefore request all of you to word your answer in the exam the way it's given in the study material, or maybe in your own language. But you should not use the terms test 1, test 2. And you may think, sir, why is this a wrong thing to do? No. See, if you look at these three aspects, and I need your inputs on this, it becomes very, very easy for us to get onto the conclusion. First of all, to check who is the issuer, then test 1, and then test 2, whether test 2 is required or not, because test 1 will always be required, but test 2 may or may not be required. Yeah. And you may think, and that's why I need your inputs from all of you. Kaustav, I'll come to your query. That's why I need from input from all of you, that do you think that by going through these three aspects, or by breaking your assessment into these three parts, by calling it as test 1 and test 2, it becomes easy for you to understand and easy for you to answer? Yes or no? Quickly. Because then I can help you the way you need to draft this in the exam. Yes, quickly. Ambika has read the solution. So Ambika, I would just quickly request you to answer. Do you think it becomes relatively easier the way we have done? Yes, quickly. Okay, perfect. So Kaustav is saying yes, sir, it becomes easier. So what I would request all of you now, that when you prepare your notes, or you might have prepared your notes, in the notes, please make a note. Okay, like at the end of the note, or maybe after any topic, you should write a note. Yeah. In that note, you should write that assessment of any instrument as financial liability or equity, wherein we consider test number 1 and 2 are only for the purposes of our understanding. In the exam, we should not quote test number 1 and test number 2. I am repeating my point. This you should add in your notes, please. That assessment of any instrument as financial liability or equity by going through test number 1, test number 2 is only for the purposes of our understanding. So in the exam also we can assess. There's absolutely no problem by going through test number 1 and test number 2. But you should not quote test number of the exam. Instead of quoting test number 1 and 2, you should just quote the sentences. So maybe while you will draft your answer, what you can simply do is ignore the words test number 2, test number 1. You should just say that first of all, we will check whether it's payable in cash or not, it's as per the contract or not, whether principal is required to be paid or not, interest is required to be paid or not. So this is nothing but your test 1. So only the terms, only the test 1 and test 2 terms should go off. That's it. Yeah. So you should again not worry. That's it. Do we need to just ignore this aspect? No, you can continue to do this, and you can also write your language. But when you write your own language, you should not use these two terms. That's it. Because this may, confuse the other party. He may think, what tests are these? Clear? Yeah? Clear? And again, you don't need to match the language of the study. If that's a question in your mind. That's it. Do we need to match that language? Again, not. Nowhere you are required to match the language. In most of the cases, your language will automatically match. It may not be 100% same, because each and every person may answer in a different language, unless you are giving the same conceptual understanding and you are using the technical terms maybe in a slightly different manner, which don't convey a different meaning. It's absolutely okay. Okay, word by word you may not match. That's absolutely okay. But please don't use these terms. That's my point to you. Yeah. But do your assessment on this basis. This will become easier. because this is what is called a step-by-step approach. Yeah. Coming back to the query of Kostav is saying, sir, why the study is using a term known derivative in the solution? Because we are not yet done with the finance instruments. There are many sessions which are yet to go on the finance instruments. So far, everything that we have been discussing has been in the context of known derivatives only. Because as such, we have not discussed the concept of derivative. When I will discuss the concept of derivative, then once again, I will come back to this definition of equity and liability. We are again not yet fully done with the definition of financial liability and equity. Okay. For the time being, what you can just simply understand is that this contract in illustration number 7 was not in the nature of derivative. That's why they are using the term non-derivative. Clear? And again, you don't need to get into so much technicality. So if you think, no, sir, this doesn't appeal to me, I'm really confused with this. Forget these two terms. I don't think just by adding one term or two terms, you will miss out big time. Because if that is creating a lot of confusion to you, these are not so important words to be used anywhere. Important thing is your final answer and the way you have derived your answer. Clear? All of you? Okay. So then we can look at some more examples now. Then I think we can look at, just a second. Illustration number 9 is what we should look at now. Illustration number 9, page 12.20. You can start reading and solving this, because now you should be very clear on this concept. A Limited invests in compulsorily convertible preference shares issued by its subsidiary B Limited at rupees 1000 each. Rupees 10 was the face value and rupees 990 was the premium at which preference shares were issued. And these are CCPS. What is CCPS? Compulsorily convertible preference share. Subsidiary is B Limited. Under the terms of the instrument, each CCPS is compulsorily convertible into one equity share of B Limited at the end of 5 years. So 5th year, this conversion will happen. Such CCPS carry dividend at the rate 12% per annum, payable only when declared at the discretion of subsidiary. Evaluate whether this instrument will become equity or liability. Now, here again, I'll need your answer broken into 3 parts. Who is the issuer? Whether test 1 is required to be performed? If yes, what's the outcome? Whether test 2 is required to be performed? If yes, what's the outcome? Yes, I'm waiting for a response now. Okay, so I missed out on your responses. You're saying that's a it's easier to understand. It's easier to follow this approach. Okay, great. Ambika, Guru, Vaibhavi, Shalini, they all have this understanding. So that's good. Then you should just continue to follow this. Yes, I'm waiting for a response on this illustration number 9 now. Okay, Chella has answered this. Very good. He's saying in this illustration, test 1 itself will call this instrument as financial liability. Okay. Final answer therefore will also be financial liability. So that means it's not required to be performed. So you see financial liability will be, final answer will be financial liability, but Chella has not mentioned who is the issuer or who is the holder. So I also need to understand who is the issuer here. Yeah, which is very important because this has been a point of confusion for many of you. So that's why this will also keep clearing your doubt. Who is the issuer, who is the holder? Yes, quickly. What about others? Okay, Guru is saying B Limited is the issuer. Great. And he's saying it's equity because no payment of principal and okay, no payment of principal. What about dividend? He's silent on dividend, but he's saying this to be equity as per test 1. And it's not fixed for fixed. So that's why it will become financial liability. That means test 2 will be required. Huh? So it's final. His answer is financial liability final. Okay, no problem. What about others? Yes, quickly. I'm waiting for your responses. Shall I saying issuer is B Limited? Okay, great. What about others? Okay, Preeti is saying issuer is B Limited, and then I think she is answering this in parts. Chavi is saying issuer is B Limited, sir. Test 1 fails because, so every time you write test 1 fails. So what do you mean by test 1 fails? Because no principal, no dividend. So that's why it's equity. Okay, so Preeti is saying it's equity. Fails means it's equity. So that's how you are understanding. No problem. So it's up to you. Test 2, fixed number of equity shares. So that's why it's equity. Okay, so Chavi has a different answer. Chavi is saying that it has to be finally equity. And I think Preeti is also answering this. So let me just see if the remaining part is received. Okay, Rohit has shared. Rohit has the same answer which Chavi has given. Okay, what about others? Vaibhavi is saying test 1 is required to be performed. Again, it's part which is received from Vaibhavi and Preeti. What about others? Should we go to the answer then? Yeah, should we go to the answer? Yeah. Okay, so let's see. Now in this case, if you look at the facts of the question, A Limited holds preference shares. And who is issued the preference shares? B. So issuer is B Limited. Okay. Now, if you look at the terms of the contract, B Limited is not required to make the repayment. Why? Because it's compulsorily convertible. So principal is not required to be paid. It's compulsorily convertible. After 5th year, necessarily conversion will take place. And if you look at the dividend, dividend is also not mandatory. It's mentioned in the question that dividend will be paid only if B Limited wants. So that's why what will it become? Equity. Now the moment we get equity as per test number 1, that means test 2 will be required to be performed. Correct? So that means we'll have to move into the stage number 3, test 2. And test 2 requires us to check two things. Whether the number of equity shares are fixed. So number of equity shares are fixed. So in this case, yes, they are fixed. Amount, is that fixed? Yes, because there's no variability in the question. Is there any variability in the question that you see? No. So that's why what do we assume? It has to be fixed. It has been agreed today itself that this is how this will be settled. So that's why what will it become? It will therefore become equity. So that means whatever is the outcome of test 1 will continue to remain same because it's fixed for fixed. And I think Shalini and Ambika have also shared the responses. I'm sure you can just go through this part now, and I'm hoping that you would have understood that where is it that your assessment went different from whatever we have discussed. All right, all of you clear on this? Any questions, any doubts from your side? Any questions, any doubts? In case you have, please let me know. Yes, any questions, any doubts? In case you have, please let me know. No? No question? Yeah? So what we can do now is we can now take a break for 10 minutes. So after the break, we will continue with our discussion on debt versus equity only. And we'll just move on to some more examples, some more assessments. And you would have now understood something which I was trying to explain in the last session, that even though we have discussed definition of financial liability and equity multiple times, I would say multiple times, still you may be thinking, sir, there are so many layers which are getting uncovered. Still, every time we get to this question, we see a different thing coming up. Still, this differentiation between financial liability and equity remains some sort of mystery, isn't it? Yeah. And that's why I told you that there's a full standard only on the differences. And the reason why I've been discussing this point with you is that if you believe that, sir, we have not been able to differentiate between these two, even after spending so many sessions, even after discussing so many times, is it that we have not been able to understand? No, it's not because that you are not able to understand. It's because there are so many things which are yet to be learned by us and which we have been learning, which relates to the difference between these two. So that's why I'm saying the concept is not yet fully discussed. It will still need more time. But the important thing is that whatever we have discussed, you need to retain that in your mind and you need to keep revising every time we meet. Because now, whatever we have discussed, which could be related to classification of financial assets, which could be related to definitions, which could be related to measurement, or which could be related to some of these differences. Now we will have to just retain all of these things and we'll have to relate to all of these points. Only then you will get a grip on the financial instruments. For example, Challa asked me a query that, sir, for this situation, can you tell me what will be the holder's point of view? That is what you need to do. Every time we discuss a situation from holder's point of view, you should also analyze yourself that what will an issuer do in this case. Or every time we discuss something from the issuer's perspective, you should answer yourself what will be its assessment, what will be its measurement, what will be its accounting by the holder. Because every instrument has to be accounted for by two parties, issuer and the holder. So it's not that exam will test you on both the perspectives, but your knowledge on both the perspectives is important, and that is what I'm calling as correlation as. And that's where you'll need all of these things to remember. Otherwise, you'll just start struggling on some of the aspects. So that's why I'm saying now the time has come wherein you need to remember that till the time we are fully done with the funds instruments, every time we meet, you need to come after revision of whatever we have discussed. And revising all of these things will not take time because we are doing all of these things in a short span of time. Yeah. So if you just spend say 15 minutes per session, that will be more than enough. Okay, yeah, but very, very important for all. Guru Raja has a query, sir. In the test number 2, why you are calling this for fixed? Because the rate is not fixed. See, important thing is not rate, it's number and the amount. The amount is fixed because it's not variable. There's no variability given in the question, so that's why we are calling it as fixed. Until unless variability is not given, you will not assume that to be variable. Shalini is saying the number of shares is fixed, but nothing is mentioned about the price. That's what I told you. That if nothing is mentioned, then you will assume that it has to be fixed. Okay. Ambika is saying the issuer is A limited in this case. Test 1 is required to be performed because settlement is through equity shares. See, I think in this case you need to just revisit your question. A limited is not the issuer. A limited holds the preference shares. That's why I told you. See, the reason why I have broken this solution into 3 parts is because one thing is for sure, that at the time of exam it will happen that many of you will go wrong on this aspect itself. And please go back to my first session. At the beginning only I told you that throughout the financial instruments, one mistake which is done by many of the students is understanding of who is the issuer, who is the holder, which you might have thought that this is so simple. You would have now understood that still we are making mistakes in terms of understanding who is the holder, who is the issuer. And please also understand the implication. The moment you change your issuer from B limited to A limited, automatically your test 1 and test 2's outcomes will go wrong, isn't it? Yeah. So that's why you can say it's something which will help you a lot at the time of examination to determine. First, start with who is the issuer. Carefully analyze it. Then get on to test number 2 and then get on to the need for test number 2. So that get on to test number 1 and then get on to the need for test number 2. Okay, that's why I have purposefully included this first step. Clear on this? Yeah? Yeah, all of you clear on this? So we can now go for the break. If you have any questions, you can just send your question in the query box. And after the break, we can have a discussion on your questions also. Okay? Yeah? Jay?
Yes, sir.
Hi, welcome back. So we can now continue with our discussion. Okay, so we were discussing about the differences between debt and equity. I have received a couple of queries. So before I move further, I'll just discuss those queries. So Kostab is asking, sir, in case of investment in equity instrument, initial recognition is fair value through P&L. So that means you are asking it from holder's perspective. Then is it possible that subsequently entity can measure it at fair value through OCI as per the option available to the entity as we discussed in the last session? Of course, yes. Of course, yes. Yeah, so that designation which the entity will do will be in relation to subsequent measurement. Then Chala has a query. As per our discussion, test number 1 is financial liability only if repayment has to be made with cash or bank, or else it is equity as per test 1. So I would say repayment to be made in cash or bank or another financial asset. Let's be precise as per the definition. What if the repayment has to be made with company debtors or other financial instruments which are not in the form of financial assets? See, if the repayment is made through a non-financial asset, then it will not be a financial liability, because financial liability requires either the payment has to be made in cash or another financial asset. Okay, clear? Yeah. Okay, so then what we can do is we can now move on to this topic further. See, there are so many things in this topic which are yet to be understood. So if you believe there are many things which you are finding new, that is absolutely okay, as we have discussed earlier also. So now what I'm doing is, now I'm getting onto the concept of compound financial instrument. And this concept of compound financial instrument is again not different from what we have understood so far. And this will again require you to do the same thing. Check whether an instrument will become equity or a liability. At every point of time, you should always remember that the measurement of financial liability is something that we have already understood. So whether it's a financial liability which has been derived through test 1 or test 2, its measurement will happen the same way like we discussed under classification of financial liabilities and its measurement. Okay, yeah. So that understanding should not change. You should just continue to have that understanding. All right, yeah. Now moving further, if you can just look at the screen, this screen gives you a couple of tables. First table talks about mandatorily redeemable or redeemable preference shares at the option of the holder. Second talks about non-redeemable preference shares or preference shares which are redeemable at the option of the issuer. So that means 4 situations have been discussed, and here again you may have the same query. That, sir, how can the preference shares be non-redeemable? Is it possible? Is it legally permitted? As I told you that when we will discuss any of these examples, you should ignore any legal challenge. Yeah, because our focus is only on accounting while we discuss any of these situations. Okay. Now, what we need to discuss is about compound financial instruments. And for the purposes of our discussion on compound financial instruments, I am keeping preference shares as the base. And there's no specific reason. I'm just taking this as an example. Okay. So now every time I will be talking about any instrument, that will be preferentials always, until unless I change it. Correct? Now let me just begin with some of the very simple instruments. Say the preference shares are redeemable. And every time we will talk about this instrument, its period will be 5 years. Means after the period of 5 years, instrument will get redeemed or will be required to be converted. Means the term of the instrument has been 5 years. Okay. So when I say preference shares are redeemable, that means preference shares will be redeemed after 5 years. And in this case, I am making A Limited as the issuer. You will say, thank God, this has been so problematic. Yes, so I've just eased down one of this assessment by you. You will not be required to do this. And why I'm putting down all of these facts is because all of these questions you need to answer. Okay, but I'll need your quick responses, not the slow responses which at times I receive from you. I'll need quick responses from all of you. Fine. Some of them may be simple, some of them may not be simple, but in every case, whatever you know, you need to answer. Okay, now in this case, let's suppose dividend is also payable. Yeah. Now the way we do our assessment of whether this instrument will become financial liability or equity is always by looking at the two components, principal and interest. Means whenever we have to check whether an instrument will become equity or liability, we need to check two components always in that instrument. Now in this case, if you look at the preference shares, these are redeemable. So that means principal will be required to be paid in cash. Yeah. So principal has to be paid. What about dividend? Interest is nothing but dividend. We will interchangeably use this term. So you should not get confused. So this is also required to be paid. So that means this repayment of principal becomes financial liability. And this component means component of interest, or in this instrument there are two components, principal and interest. This component interest, this also becomes financial liability. So this is because both of them are repayable, and that is why this entire instrument will become financial liability. Yeah. And you may say, sir, this was easy to understand, why we are getting into it. Yeah, I agree with you. This was easy to understand. Let me just change the facts now. Let's suppose preference shares are convertible and this is not payable. Not payable means it's at the option of A Limited whether to pay this or not. Now in this situation, what will happen? Principal will not be paid. So this principal component will become equity, and this interest is also not payable. So this component will also become equity. So all in all, this instrument will therefore become equity. Correct? Yeah? Okay. Now I'm changing the facts again. Let's suppose principal is redeemable. That means preference shares are redeemable after 5 years, but dividend is not mandatorily required to be paid on them. Now we have a slightly tricky situation, and that's why I need your help. Okay. Now, in this situation, what will be your assessment about these two and your final assessment? In this situation, what will you call this instrument as? And you should break your solution by answering these two parts first and then giving me the final conclusion. So I would say this is the conclusion. These two are the bases. So this is basis 1. This is basis 2. Okay. Yeah. And in this case, while you will answer all of these questions, please ignore the requirement for test 2. Because one question that should immediately come to your mind is that, sir, in the last question we discussed about one instrument which you called as equity, but therein you didn't test you didn't test about this test number 2. I agree, because we are assuming that everywhere when the conversion will happen, it will be fixed for fixed. So you can say I am assuming fixed for fixed wherever it will be applicable. Okay, that's assumed wherever it will be relevant. In case of financial liability, it will not be relevant. So please don't assume that in the case of financial liability. Okay, yeah. This is assumed wherever relevant. And I am waiting for a response. Huh? Yes, quickly. What's your response? Ambika is saying, sir, principal will be equity and interest will be equity. So therefore, it should become equity. And this is test number 1, correct? Okay. What about others? What about others? What is your assessment? Quickly, I need your responses quickly today. There are many examples I'm planning to do. So if you respond late, you will get delayed. Huh? I want you to be fast. Cost of is saying that it should be financial liability, means principal should be financial liability and dividend should be equity, and therefore it should be compound financials. Okay, any more responses? Because I have received 2 different answers. So if I receive any more response, that will help me. Chavi is saying that principal is financial liability. So Chavi is going with cost of, okay, and interest is equity. So that's why Chavi's response is C. Okay, great. Now in this case, principal is redeemable. So that's why it has to be a financial liability. It cannot be equity. I think you need to revisit your answer, please. Why did you call it as equity? And in this case, dividend is definitely not payable. So that's why it has to be equity. So this is fine. Now the moment we say there are 2 components in the instrument, what would it become? Compound. Compound means mixture of 2. This instrument has financial liability as well as equity. Correct? Yeah. Now an instrument which has got both the features, let's see how do we measure it. Because that will give you more understanding about this concept, the measurement. And you don't need to understand a new concept today. It's the same concept that I will apply in terms of measurement of financial liability. This is 5th year, this is 4th year, this is 3rd year, 2nd year, 1st year, and day 0. For any financial instrument, what did we understand? That initial recognition has to be at fair value. For a financial liability, what will be the fair value? present value. Okay, yeah. Now in this instrument we are saying principal is financial liability and interest is equity. Whenever we have any compound financial instrument, then the standard requires, first of all, measurement of financial liability to be done. Means what should we do? We should measure financial liability component first of all. Let's suppose the amount of the preference shares is rupees 1000. And what is the dividend rate? Let's suppose that is 10%. Okay, and let's assume that is also at market rate. But in this case, because it's not repayable, that's why what do? We will have to discount it. And when we discount it, will the present value be different? Yes, of course, it will be different. Let's assume, again, I'm not getting into the exact computation. Okay, let's assume the present value comes out to rupees 700. You may think, sir, why by taking 10% you are calling this as 700? This is only illustrative. The number may be different, huh? Let's assume present value is 700. So what will be the value of financial liability in this case? 700. Yeah. Now every year interest may have to be paid. But is that required to be paid? Not at all. Not at all. So do we need to measure interest? Yes, but in the form of equity, not in the form of financial liability. And how is equity measured in case of compound financial instrument? Standard says for measurement of equity, residual amount should be taken. Means from the total value of the contract, reduce the value of financial liability. That means 1000 minus 700, and that will become the value of equity. Which means that issuer will always segregate an instrument into two parts, or you can say compound financial instrument into two parts, and both the components will be recognized separately. Financial liability equivalent to 700 in the financial statements and equity equivalent to 300 in the financial statements. Okay, clear? Challa has a question, sir. Why should we ignore test number 2 in case of compound financial instruments? Because we are making an assumption. It's not a concept. It's not a rule. For the purposes of our example, to keep it simple, I'm saying ignore it. Why? Because I am assuming that fixed for fixed will be applicable or will apply wherever it will be relevant. Yeah. In this case, it will not be relevant because there is redemption. So in case of redemption, do we issue equity shares? No. So that's why it's not relevant. I'm saying, let's suppose if the conversion was to happen, then I would assume that conversion is fixed for fixed. Just to keep it simple. So you should not think that test number 2 is not required to be applied in compound financial instrument. That is required, but it's for simplicity's sake. Okay. Clear? How do we measure compound financial instrument? By segregating into two parts. First, you will measure financial liability always. And it's a rule. You cannot measure equity first and take the difference of total amount minus equity as the financial liability. No. You have to measure financial liability always first. The difference between the total contract amount and the financial liability has to be equal as per the standard. Okay, clear on this? Let's suppose I change the facts. Let's suppose this is payable and this is convertible. Yeah, let's suppose this is convertible and this is payable. Now, once again, we will have to apply the same principle to check the outcome, to check the assessment. Now, in this case, principal is what? Equity. And interest is what? Financial liability. And what does the contract requires? That every year interest will be paid at 10%. Now in this case, at the end of first year, 10 will be paid. At the end of second year, 10 will be paid. 10, 10, 10. So all in all, over a period of 5 years, rupees 50 will be paid. Correct? Yeah. Now in this case, how do we compute the financial liability? Again, the same thing. We need to compute the financial liability by taking its present value. And how do we take the present value? We will compute the present value of rupees 10. We will compute the present value of rupees 10. This present value will also be computed. Present value for this rupees 10 will also be computed. Present value for this rupees 10 will also be computed on day 0. Okay. How do we compute that? Again, by applying the present value factor at the rate 10%. Or at the rate, whatever the rate is mentioned in the question as discount. Correct? Let's assume present value of all of them. Present value of all of them comes out to 30. Let's assume present value of all of them comes out to 30. In this case, what do we do? In this case, 30 will be the financial liability. And the difference between 1000, that means total contract amount, and this financial liability will go to equity. Correct? Clear on this? Yeah? Sorry, Kaustav is saying, sir, this should not be 10, it should be 100. Sorry, I considered this amount to be rupees 100 and computed this. So this will change. Yeah. So this should be 100, 100, 100, 100, 100. And let's make it 300. Let's make it 300. So this will be 300. All right. Yeah. Thanks, Costa, for this. Guru Raja is saying, sir, in this case, how can we go for test 2 if there are both the components? In this case, if we have both the components, for this component which we have classified as equity, we need to check whether this equity will continue to remain an equity as per test number 2 or not. Because what is this test? This test that we have performed is test number 1. Test number 1 is giving you the outcome of equity. It's not test number 2. That's why for equity, once again you should check as per test number 2, it will continue to remain equity or it will become financial liability. Clear, Guru? Yeah? Clear on this? But why did we not go to test number 2? Because we are assuming that fixed for fixed criteria is met in this case. Chala, you are clear? Yeah? We are assuming that in this case, fixed for fixed criteria is met. That's why test 2 is also performed in a way and we have got the same outcome of equity. Clear? So I'm hoping that you have understood how the measurement of 2 components will be done in case of compound financial instrument. All of you clear? Any questions from your side on this? Yes, quickly. Any questions from your side on this? No? I'm not yet done with my discussions about various types of compound financial instruments. Idea was to just get into this understanding in between, but this will be helpful for the purposes of your assessment. Okay. Kostav is saying, but sir, for compound instrument, test 2 will always fail. Why? Only for the equity component you will check whether test 2 will make it equity or not. Like in the last example, principal, which is equity, for that you will check, for that component you will check whether the number of equity shares which will be issued are fixed. Let's suppose the question says number of equity shares will be decided later on, and the amount at which it will be issued will be dependent on the market value later on. So will you call it as equity then? Or will you continue to call it as equity? No. In such a case, this equity will become what? This equity will become financial liability. Okay, clear? Now I'm bringing in some more instruments which need to be answered by. Let's suppose preference shares are redeemable and dividend is also not mandatorily payable. Yeah, there is an option with the issuer to convert into equity shares at any point of time. Clear? There is an option with the issuer to convert the preference shares into equity at any point of time. This option is only with the issuer. Now, tell me about principal, interest, and your conclusion. Yes, I'm waiting for a response. I'm waiting for a response. What do you think this instrument will become? Equity, liability, compound finance instrument, or none of them? Chala is asking, sir, in case of interest or dividend not payable as per test 1, it is an equity. How to check these in test number 2? So those will not be checked. Yeah, those will not be checked because against those, no shares are required to be issued. So test number 2, you will only check when the equity shares are required to be issued. Therein you will not check, or even if you check, that will not be of any relevance. Yes, now for this instrument, can you tell me what's your outcome? Quickly, I need your responses quickly, please. Yes, quickly. I need your responses quickly, please. Okay, so Kaustav is saying if option not exercised. No. Yeah, no ifs and buts, please. When you will answer in the exam also, please remember you cannot do ifs and buts. Your answer has to be conclusive. Conclusive means you need to come to one conclusion. Yes. So what do you think will be the answer over here? I don't think two answers are possible. Okay, great. Rohit is saying, so principal will be equity, interest will be equity, and therefore it will be equity. Guru is saying principal is financial liability because there is contingency. Okay, very good. What about interest? It's equity, and therefore he is calling this as compound financial instrument. Yes. What about others? Yes. Any more responses? No. So let's go to the solution then. In this case, preference shares are redeemable. So let's look at it from issuer side. Is there any way through which issuer can avoid payment of principal? Yes. That option is available with the issuer through which it can avoid payment of principal as per the contract. So that's why, will the principal be mandatorily payable? The answer is no. So what will it become? Equity. If you look at interest, that is not mandatorily payable. So this has to be equity, and therefore this instrument will become what? This instrument will become equity. Okay, yeah. So let's change the facts now slightly. Let's suppose instead of issuer, holder has this option. Let's suppose this option is with the holder only. This option is not there with the issuer. This option is with the holder only. Now what will happen? Now what will happen? Yes, quickly. Any inputs from your side on this? Yes, quickly. Any inputs from your side on this? Now I have changed this question slightly. All other facts are same except that option of conversion into equity at any point of time is with the holder only. It's not with the issuer. So now, do you think your answer will change or it will remain same? Costa is saying that principal will now become financial liability and interest will be equity, and therefore it will be compound financial instrument. So let's understand this. Now in this case, if you look at it from the issuer's perspective, does he know about the holder, whether he will convert or not? No. So he will assume that he will be required to pay. So for him, it will be financial liability. Interest is not required to be paid, so that's why it will be equity, and therefore this will become compound financial instrument. Okay? Yeah. Let's suppose subsidiary company. Let's suppose a subsidiary company has issued preference shares to its holding. Subsidiary company has issued preference shares to its holding. Preference shares are redeemable after 5 years. Okay, but dividend repayment is not mandatory. Yeah, it's interest free. Or instead of preference shares, let me just say it's a loan. It's a loan. Say subsidiary has taken a loan from its holding. So that means holding has given a loan to a subsidiary. So who is the issuer now? Issuer is again subsidiary company, on which interest is zero. Interest is 0%. And I'm not bringing in any option, etc. I'm just not bringing in any options, etc. Now let's see what do we do in this case. If you look at this instrument, if you talk about principal, is the principal required to be paid by the issuer? The answer is yes. So what will it become? Financial liability. Is the interest required to be paid? Yes, it's again a financial liability. Therefore, if you look at the conclusion, it's a financial liability. And you may be thinking, sir, how is the interest payable? It's 0%. I'm saying whatever is the percentage that has to be paid, yes or no? But because it's 0%, that's why it's implied that interest is not getting repaid or not getting paid year on year or even at the time of repayment of the loan. That's why what will happen? This loan, which is a financial liability, will have to be discounted. So we will have to compute the present value of this loan. You remember financial liability measurement we discussed. Therein, what did we discuss? That compute the present value of the financial liability. Let's suppose it comes out to 700. Now in this case, how do we record the 700 as? So let's look at the accounting entries. I'm looking at the accounting entry of subsidiary. Subsidiary will say bank debit 1000 to financial liability 700. But what about remaining 300? What about remaining 300? What will happen to that? Where do we take it? In this case, do we say it's a financial liability? The answer may be yes. But that financial liability is not required to be paid. That's zero. Now in this case, do we call it as deferred income? Something which we discussed in case of financial liability when we were discussing about lease deposit liability. You remember? Lease deposit liability. Yeah, let's suppose this was the lease deposit. This gets discounted. So it's recorded at 700. What did we say? That 300 is a income which is deferred and which will be recognized over a period of 5 years. Yes or no? So do we say it's deferred income for the subsidiary? Do we say it's a deferred income for the subsidiary? The answer may be yes. There's no doubt that it's a deferred income for the subsidiary. 300 is nothing but the deferred income for the subsidiary, which should be recognized over a period of 5 years. But in this case, there is another principle of the standard, which says that whenever there will be any such transaction between the holding and the subsidiary, or between two group companies which are under the same parent. I am repeating, whenever there is any such transaction between the holding and subsidiary company, or between two companies which have same parent, then instead of taking this to deferred income, or instead of recognizing this as income, we should take this amount to equity. We should say this will be equity. Why do we do this? Let's understand the logic. Because if you understand the logic, automatically many of the questions which will be coming to your mind will go away. See, holding and subsidiary are related parties. We all know about it. Let's suppose if we keep the provision of taking this 300 to deferred income. Let's suppose if we keep the provision of taking this 300 to deferred income, then what will happen? In the first year, this 300 will be amortized. So 60 will be the income. 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 So that means every year, subsidiary company will record an income of 60 rupees in its P&L. And that is as per the requirements of the standard. And what the group companies can do is that if the group company wants, or if the group wants this subsidiary to show any income, what they can do is very simply they can pass on a loan to its subsidiary. Simply. So they will do a transaction that holding will give a loan to its subsidiary, for which subsidiary will start recognizing an income, which is not appropriate. Which is not appropriate. So this is how this manipulation can be done by the group companies. Though their intent will not be to give the loan, but just because subsidiary can have some income in its financial statements, in its P&L, holding can give the loan so that subsidiary can book the income. And if you look at the substance of this transaction, what is actually happening? Ideally, subsidiary should have received a loan of rupees 1,000 at market rate. At market rate of interest. Which should have been paid by the subsidiary. Let's suppose if the market rate of interest was rupees 10%. So this becomes 100. So every year 100 should have been paid by the subsidiary to the holding. In such a case, what would have been done? Present value of this 100 would have been computed, 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 this 100 will also have been computed. And the present values of all of these interests would have become equivalent to 300. Those would have become equivalent to 300. Because of which this amount would have been equivalent to 1,000. So whenever an instrument will have market rates of interest, its present value will always match with the future value. And that's the logic which we discussed in the last session also. That only because the transaction is happening below market rate of interest, there will be a difference between the future value and the present value. Correct? So if you take a loan from the bank at market rate of interest, if you discount it today along with all the interest flows, so all the interest flows will be discounted and all the principal repayments will be discounted. So its present value will always match. Why? Because the transaction is at market rate. Only when the transaction is not at the market rate, present value will be different and which actually goes to equity or deferred income. Correct? Now, because this transaction is not happening at the market rate of interest, it's below market rate, it's interest free. That's why what do we say? Holding has given a kind of non-cash benefit to the subsidiary. Yes or no? Holding has given a kind of non-cash benefit to the subsidiary. So holding can definitely contribute towards the subsidiary. There's no doubt. So whenever subsidiary may require, holding may put in an investment. Parent can definitely put in an investment in the company. And when the investment will be given by holding company, what will happen? Subsidiary will issue equity shares that will become investment for holding. But in this case, subsidiary has not issued any equity shares. But at the same time, in substance, it's no different from that. It's no different. It's a capital contribution from holding to the subsidiary. And that's why, what is this 300? It's not an income of the subsidiary. It's deemed equity. Means it has the same color like it will have for any equity shares. So in a way, what is this subsidiary doing? Subsidiary is issuing equity to the holding, against which cash is not coming, but which is okay. So we are not really concerned with the cash. For us, important is to understand the substance. So in substance, what will it become? It will become equity instead of deferred income. Clear on this? Yeah. Now in this case, we should also understand the mirror entry for the holder. Let's go to the holder now. Let's understand how will the holder record this. So this was issued for holder. First of all, we should complete our assessment for holder. Loan is given to subsidiary. So will it be a financial asset? Let's think. Is there a contract? Yes. And will the holding receive cash? Yes, it will receive cash. So will it be a financial asset? Yes, it will be a financial asset. Now we need to check whether this financial asset will become equity, whether it will become amortized cost or fair value through OCI or fair value through P&L. Now, if you look at this transaction, holding has given this loan for a fixed rate. And holding is not selling this loan in the market. So that means business model is hold to collect. And what are the returns which the holding will get from subsidiary? Principal and or interest. Holder is not getting anything beyond interest. And you will be thinking, sir, interest is also not coming. That's fine. That's fine. As we discussed earlier, interest may be zero also. But we are not crossing the interest limit, which is not consistent with basic lending arrangement. So what will become therefore? It will become SPPI and therefore it will get into amortized cost. It will go to amortized cost. And let's see how will amortized cost accounting be done. Again, the same thing. Holder will say this 1000 needs to be discounted today. At the discount rate of holder, let's assume it's same 700. So what will the holder do? Holder will say to bank, because holder has given a loan of 1000. And holder will say loan to subsidiary debit 700. Yeah. When we discussed similar example in case of lease deposit given by the holder, the difference of rupees 300 was taken by us to prepaid expense. Therein we said that it's a kind of loss which the holder has done. Why? Because he should have ideally given 700, which should have become 1000 at the end of the 5th year, and which would be the right way to do the accounting. But in this case, will it now be appropriate for the holding company to call it as an expense? Again, no. Because again, it's a non-cash benefit which the holding is contributing towards the subsidiary. So that's why, what do we call it as? Instead of prepaid expense, we will call it as investment in subsidiary. We will call it as investment in subsidiary, or to which we can give a separate name, capital contribution. This is technically known by this name, capital contribution. Okay, capital contribution. You may be thinking, sir, how is it different from any other investment which holding would have made in subsidiary? That means, let's suppose, sir, if the holding buys some more shares of subsidiary, then the accounting entry which they will pass is investment in subsidiary to bank. And now they have given interest-free loan to subsidiary. Therein also we are passing this accounting entry, investment in subsidiary to bank. Yeah. Now in both the cases, can we say that it will be investment in subsidiary? The answer is yes. Because in both the cases, in substance, what is happening? In both the cases, in substance, holding is contributing towards capital of subsidiary. Subsidiary is getting some capital. Subsidiary is getting some equity, which holding is contributing. In the first instance, subsidiary may be getting cash. In this instance, subsidiary is not getting cash, but it's getting non-cash benefit, which is okay. So it's not necessary that holding will always pay cash to the subsidiary to buy its equity shares. Now in this case, in a way, to buy its equity, subsidiary is saying that I will pay your interest. How? By giving you interest-free loan. Yes or no? Yeah. Now you are clear on this concept. Yeah. Now, if you look at this instrument, so the reason why I picked up this example of holding and subsidiary at this point of time is that if you look at this type of instrument, what do we call it as? Again, compound finance instrument, wherein the interest component was not necessarily equity. If you technically look at the requirements of interest, it's not really equity. But still, because the measurement is such that the difference goes to equity, that's why we call this instrument also as compound finance instrument. And I'll also bring in one complication over here, okay, which is very, very important for you to understand. And I'm not sure whether this question was there in your mind, because this question should come to your mind. You should say that, sir, we analyze this instrument as amortized cost. Yeah. At one point of time, we are saying that issuer is calling it as compound. Why? Because issuer is taking this instrument into two parts. One goes to debt, other goes to equity. So that means this instrument has some color of equity. Remember? Yeah. And sir, if you remember, we discussed that the moment an instrument will become equity for issuer, that means for holder, it should go to fair value through P&L. Then why we are calling it as amortized cost? Yeah. Does this question come to your mind? If not, then you should think about it. Yeah. And if that is coming to your mind, let's again understand that initially, when we classified this instrument, we did not classify this instrument as compound. It was because of measurement, we got this difference of rupees 300. And because of this difference of rupees 300, we should have taken this to deferred income. Yeah, we should have taken this to deferred income, but there is another principle in Ind AS which requires that whenever you get any sort of income and which is due to any transaction between holding and subsidiary, only in such cases you will take it to equity. Okay, so this is the reason why equity has been generated. So in this case, because of this equity, holder is not getting any return which is over and above interest, which is not consistent with basic lending arrangement. Okay, this point is very, very important to be understood, because you might have understood this point now, but this may confuse you later on. That's why what you should do is now you should write this in your notes in your own language, the way you want this to be understood later on. Because this aspect that I have explained you now, you may get confused later on. Clear? This is one of the most important principles which is practically applied by many companies in India. So some of the large group companies had a lot of similar transactions wherein those companies have sort of created this notional equity and notional investment. Why I'm calling this as notional? Because this is not actual equity, this is not actual investment. This is getting generated. This is non-cash benefit. Under Indian GAAP, you would have not recorded this amount. Under Indian GAAP, you would not have recorded this investment or equity. Now under Ind AS, these items are getting recorded. Okay, yeah, that's why accounting has changed significantly in respect of some of these type of instruments under Ind AS. All right, all of you clear on this? If you have any questions, any doubts on whatever we have discussed, please let me know. Because with this, we are done with our discussion on compound finance instruments. My plan is to discuss one illustration with you. Yeah, but I'm thinking that I'll give you that illustration as homework now. So let me just get on to that illustration. Let me just pull out that illustration, which you should practice. In the meantime, if you have any questions, please let me know. Yes, any questions in case you have? So illustration number 31 on page number 12.49. You should attempt this once. Page 12.49, illustration 31 is your homework. Yeah, it seems to be connected to one more illustration which also will have to be understood by you, answered by you, but this is your homework. You may or may not be able to solve this illustration, but it's very important that you attempt this. Okay, yeah. If you are not able, if you will not be able to solve this, that will be okay. We can also do this later on, but you need to attempt this. Yes, now I can move on to the queries. Chalai is saying, sir, can this application used in the already made in the prior to Ind AS? Chalai, I'm not clear on your query. What is it that you have been trying to ask? Can you please repeat your query, elaborate this? Yes, any more questions, any more doubts in case you have on this, please let me know. About this principle of interest-free loan from holding to subsidiary, are you now clear on this? I'm hoping you have noted down. Yes, any questions in case you have on this, please let me know. No? Any questions? Hoping you have noted down the homework. Huh? this homework and the accounting entries. All of these accounting entries you have noted down for subsidiary and holding for both. You should note down these accounting entries. And when you write this example with the numbers, please write a note that this computation of 700 is not exactly as per the rate of interest which I have picked up. This is only illustrative. So maybe the rate of interest, if you have written anywhere, you can ignore it. Yeah. If you have written the rate of interest anywhere, you can ignore it. It's not necessary you write rate of interest, but these accounting entries you should note down. You may have a question based on this. So this is nothing but a part of your notes. That's why you should note it down. All right. Any questions? Any doubts? Okay, so Vaibhavi is asking about question number 22 of homework of last class. So Vaibhavi, can you please refer to that page of question number 22? Which page was that? Yes, quickly, if you can just let me know the page number or maybe the unit number, please. Let me just try to find that. I think this is page number 12.89, if I'm correct. This is page number 12.89, if I'm correct. Yeah. It seems to be a big one. So what we can do is maybe in the next session when we'll start with solution of this illustration number 22. Fine, Vaibhavi? Yeah. Kostav is asking, sir, suppose the interest rate would have been 10% assumed instead of 0%, then the situation we discussed will not arise. Of course, then we'll not have any such difference. Yeah, then it will be pure core accounting entry. Bank debit 1,000 to financial liability 1,000, loan given 1,000 to bank 1,000. Then it would become simple. Challa is asking, sir, in this CFI, between holding and subsidiary, same logic will apply if the same transaction happened prior to Ind AS. Now we need to remeasure it. See, let's suppose if this transaction took place prior to Ind AS, let's suppose under Indian GAAP. Then under Indian GAAP, you would have done this accounting. Now, when you move to Ind AS, you will have to remeasure it. You will have to do retrospective application. But all of this accounting will be done on the date of transition as per Ind AS 10. Okay. Yeah, Vaibhavi, I got the page number. So what we can do is, considering the time, because we are moving towards the end of the session and this appears to be a long question. So what we can do is, I can understand your query related to interest. I'll go through this question and I'll come back to your question in the next session. So in the next session when we'll start with this illustration number 20. Fine. Yeah. So with this, what you should do is, you should get on to this illustration number 31 as homework, and my request to all of you is to come prepared with the topics that we have discussed. In the next session, we will continue with our discussion on debt versus equity. That means we will continue with Ind AS 32. Yeah, but very, very important that you revise. All right. So with this, I would like to thank all of you once again for your time and for your wonderful participation. Thanks so much.